Now, academics around the globe have studied characteristics of financial markets and companies, and one thing they found is that over time, stocks do better than bonds. That makes sense, right? If you invest in the stock market over 20, 30, 40 years, you're probably going to do better than investing in bonds or cash. Of course, it's going to be more volatile, it's going to be a bumpier ride, and there's even years in which stocks have fallen significantly, or when cash or bonds have done better than stocks. But again, you're focused on the long run, and you expect that in return for the volatility, you're going to get better returns from the portfolio of stocks than cash or bonds. Let's look deeper. Academics have found that even within the stock market, there have been certain kinds of companies that have done better than their peers. For instance, more profitable companies have done better than less profitable ones, and that makes sense. Less expensive stocks, those are known as value stocks, have done better than more expensive stocks, which are known as growth stocks. And that again makes sense, right? If you have two comparable items and one is on sale, wouldn't it be a better purchase? That's logical. The irony, though, is that if you think about the mall when people used to go to malls, if you went on the Wednesday before Thanksgiving, nobody was there. But if you went on the Friday after Thanksgiving, it was packed. People love a sale in every area of their life except when it comes to investing. And then there are small companies. Small companies have done better than large companies over time. Flipping over to the bond side, academics have found certain tendencies there as well. For instance, longer maturity bonds have done better than shorter maturity bonds. Less creditworthy companies have produced higher returns than more creditworthy companies. Again, this is all logical. If you were lending your friend money, the longer you lent them to, the more risk you'd be taking. The lower your friend's FICO score probably, the more risky it is as far as them paying you back. But you'd need more return then. If you're going to take on more risk lending, you'd want more return, same way it works in the bond market. Now, you want to position your portfolio so you can take advantage of this academic research, and that's also going to enhance your diversification and potentially give you better outcomes in some environments. Here's an example of when that would have really helped you. This is called the lost decade, and that's the period from 2001 to 2010 during which the S&P 500, which is mostly large company growth stocks, experienced negative returns over the course of a decade. The reality, though, is that it was only a lost decade for investors that had concentrated all their money in large U.S. growth companies. Many investors do this, so you might want to look at your own portfolio, see how you're invested, make sure you're not concentrated only in those large growth companies. Because think back to that lost decade. If instead of investing in the S&P 500, you had invested in international companies, you'd have gotten a 27% return. In the US, we talked about the S&P 500 losing money. Well, large value companies made 50%. Nobody likes bonds. Everybody complains the returns are too low, and yet during the lost decade, here's an example of why you own bonds. Think about it. Somebody that was trying to generate a paycheck from a portfolio in the S&P 500. Not only are they pulling income from that portfolio every year, but the value is declining along with the market. Owning bonds during that decade, you might have been living off the part of your portfolio that was up 80% like bonds were, giving stocks time to recover. Of course, we all know real estate, right? Big decline in 2008 led to the financial crisis, but for that decade, real estate investment trusts were up 175%. Emerging market stocks and U.S. small company value stocks up 200% plus. And what about the big winner? You definitely didn't have a lost decade if you invested in emerging market value companies that soared over 400% in that decade. That's the panda bear. That would have been if you put all your money there paying $1 and getting lucky. But if instead you own some of everything I just discussed, that's walking up to the darts, throwing $20 worth, getting the panda bear, and getting a successful outcome.